Hi, it's Hans Lysglimt here. It's been a while since I posted and video blogged on the YouTube channel, but here we are. It's November 17th, and I have set up a little studio or set up my video equipment here in my office in Oslo. We're over in Storo. It's a little ridge overlooking downtown Oslo, and you can see downtown Oslo right behind me from the window here in the office, and I'll try to zoom in to give you a view of Oslo. As you can see, it's a rather gray and dull November day, November 17th in Oslo. Down there you can see the municipal hall. You see the boats coming in. This is where, of course, Obama will be on December 10th to receive the Nobel Prize, just downtown Oslo here. We zoom out again, you will see that the Oslo fjord as such is here, going out to the North Sea and Denmark and all that way out. And here is the inner Oslo fjord basin, where all the boats and the cruise boats, they come in here. And this is a little fjord that goes downwards. So this is pretty much all of downtown Oslo, as you can see here, with some of the islands on the outside. Well, anyway, November 17th, and the markets have rallied. They've had a tremendous rally since mid-March when the stock markets bottomed out. And what's happening is that the new liquidity that the central banks are pumping into the system is finding its way into capital assets, because the consumers are cutting back, the consumers are saving, and the consumers have actually changed their behavior. This is a different world. This is a different economy from what it was before the crisis. But the central banks, of course, they have their inflation targets, so they need to pump in money into the economy in order for prices not to drop. That is their number one goal, to make sure the prices don't drop. So what they're doing is that they're printing all this new money, giving all these easy credits, and having all these low interest rates towards the banks. But consumers aren't spending, consumers aren't lending, consumers are cutting back, and so are corporations. So what's happening? People are borrowing money, and first of all, institutions are borrowing money and buying capital assets, buying stocks, buying partly real estate, buying gold. That's why we have such a tremendous rise in gold and silver, precious metals. So what's happening is that all this new liquidity was supposed to go into the consumers so they would buy more products and make sure that the consumer price index went up a little bit, as they want to. But they're not doing that sufficiently. So what they do, they're pumping in more and more and more money in a desperate attempt to ensure that prices don't fall. And the money flowing all into capital assets. So, okay, so what's going to happen? What's going to happen? We are seeing right now a miniature scenario of what happened during the 2000s. What happened during the 2000s is that it was the same phenomenon, but the deflationary force then was mostly cheap imports from Asia and China. And they pumped in money in order to keep prices up. The money went into equities, prices went down due to cheap imports, and even more money was pumped in, went into equities. But eventually, equities reached a ceiling where it could no longer go up, because there was such a discrepancy between reality, what the stocks were making, what the companies were making, and the price of the stocks. And what happened then was a collapse, a loss of confidence, a self-reinforcing spiral downwards. This happened basically from 2001, 2002, all the way until the crash happened in 2008. And what we're seeing now is a compressed version of that. The deflationary force right now is fear and change of behavior, change of consumer behavior. And the inflationary force, of course, is the money printing from the central banks. That's the same as before. And what's happening is that equities are going up, and capital assets are going up. Gold is going up. Commodities are going up. But this will eventually reach a ceiling. We don't know where that ceiling is. Well, we do know where it crashed last time. I mean, that's another 50% up from here. But I don't think it will go that far, because the markets have been really shaken. And also the reality of the economy is different. They're making less money now, relatively speaking, than, say, 2007. So we are approaching that ceiling very fast, where all the new money is still chasing after stocks and equities, but people realize that, this is no longer sane. This doesn't make sense anymore. The prices have been pushed up so high that it's not rational anymore. And when that changes, when the psychology of the market changes, when greed, we have greed right now, when greed turns to fear again, we are going to have a fierce downturn in the stock market. It's going to be ferocious. It's going to be very sharp and very quick. And people will say to themselves, my God, why didn't I sell at the top? I got to save whatever I made. And downwards, we could fall to new lows very easily, because last time there was the resistance all the way. People were saying, oh, this is so cheap and this has never happened before in the modern economy and so on. So there was resistance all the way. Some buyers were coming in. But this time when the market falls, there won't be those buyers, because everybody knows how far down the market can easily fall. So it will be a very rapid and dramatic fall. Then, of course, the big joker in the game is, what will the central banks do? Because last time they slashed interest rates, and they were able to mitigate the fall by slashing interest rates all the way down. But now they can't do that anymore. In the States it's zero. In Norway it's a little above 1%. And it's not possible to do those dramatic cuts anymore. So they will have to do something else. What I believe they will do is that they will start distributing money out in the economy into people, into consumers. So pensioners will receive $1,000 check in the mail, just congratulations, for whatever. Or children will get extra money for food or something like that. They need to distribute the money out to the consumers, where the consumers will actually spend the money. So the next rounds, the next TARPs, and the next these programs to fix the economy will be different. It will be about pushing money all the way out to the consumers. And that's when inflation is going to hit, because eventually the money is going to flood the economy. People will get enough money to sort of stop the deflationary forces just by distributing the money. But eventually it will level out, and then it's too much money in the system. So we will have an explosion of inflation, and that will wreak havoc everywhere. It demands deep analysis. Will be the crisis and the spectacle of our lifetime, economically speaking. And the next consequences of the inflation that comes later on will be massive price in gold and all that. So this is Hans Lysglimt. It's November 17th. I hope you're listening, and I'll be back video blogging soon. Thanks.